Howdy y'all, Stock Warden here, back with another video. And today we're looking at Sensus Healthcare and how their third quarter has stacked up against the rest of the year. So far they have done really well with their financials, and to kind of go over some of the highlights of their third quarter, the Centers for Medicare and Medicaid Services have established coding validating superficial radiotherapy for treating non-melanoma skin cancer. They have increased revenues of $6.9 million. They have shipped 16 SRT systems, including 3 to China. And the Fair Deal Agreement, the FDA, treatment volume has increased 20% over the second quarter. Excited the quarter with $24.5 million in cash and no debt. So that is a huge undertaking that Sensus Healthcare has been able to jump into and accomplish, to be able to have no debt and to be able to have their products pushed out into a greater light across a more broad spectrum and even across into other countries as well. That is a amazing feat to be able to show for this company, and also we can see now that the stock is kind of finally perked up a little bit on some bullish territory, where we're still not anywhere near where we were up at the almost $6 a share back in August. So we've seen this heavy dip here lately, and then now we're finally starting to come back into everything. Now, H.C. Wainwright & Co. maintains a buy on Sensus Healthcare, and they lowered their price target to $8 a share. Lake Street maintains a buy on Sensus Healthcare and lowers their price target to $6 a share. Now, both of those price targets were stated over 3 months ago, and they have yet to be able to come out and re-say what they are dubbing the new price points for Sensus Healthcare is. So if they're not saying that they're going to move on anything, then that still means that they're going to keep their price points where their price points are currently at. So that still means that with us sitting at $4.04 a share, that this stock is tracked for 100% increase, for a 50 and 100% increase for their price targets. So we'll go ahead and get a little bit deeper into the third quarter's financial results. So the revenues was $6.9 million for the third quarter, which compared to $8.8 million for the third quarter of 2024, which was a decrease of $1.9 million. But that was due to a lot of the issues with the number of units sold in the third quarter, because they only sold 16 this year in the third quarter compared to 27 in the third quarter of last year. So the decrease in revenue was primarily driven by a lower number of units sold to the large customer in the third quarter of 2025 compared to 2024, which is just slightly offsetting by revenue recognized from the new placement program under the FDA. So the cost for sales was $4.2 million for the third quarter of 2025, compared with $3.6 million for the third quarter in 2024. And this increase was primarily related to higher cost of servicing the systems and the cost associated with the new placement program compared with the prior year period. So even though they haven't necessarily been able to sell more units, they've been able to capitalize greatly on the number of units that they already have out. So they're able to vertically integrate and also vertically profitize off of their product in many different aspects than just selling their product as is. So their gross profit was $2.7 million for the third quarter. So the gross margin was roughly 39.1%. So, and all of that is once again associated with higher costs for servicing the systems and the new placement programs. Excuse me. The general administrative expense was $1.9 million, and with the increase reflecting higher IT and professional service fees and compensation as well for servicing all of their products as well. Their selling and marketing expense was $1.5 million, which is up from the 2024 third quarter at $1.3, with the increase reflecting higher headcount and payroll costs due to commissions related to the new placement program. Then they also had their research and development expense being $1.8 million for the third quarter, because they are reflecting significant lobbying costs related to billing code reimbursement, higher headcount, and an increase in product development cost related to their next generation systems on their large RAD systems. So other incomes, they have created $0.2 million of income, which was just primarily brought into interest income. So their net loss for the third quarter was $0.9 million, or roughly 6 cents a share, compared with a net income of $1.2 million, or 7 cents per diluted share for the third quarter of 2024. So that brings the stock down to wherever their main level would be. That takes the stock and that waters it down from not only 6 cents, but with a 7 cents diluted share, then your 7 plus 6 is 13. But with the shares being diluted across the 7 cents, your 13 cents is more or less about 25 cents in the end of it with how far out it's pushed. But the stock has had a pretty heavy range of price here lately, where, over the course of the past year, this stock was way up. This time last year, we were in the $6 range and going up and above the $8 price target as well. But since then, this stock has continually went down and has been having issue after issue. But now, with this third quarter coming in and them being able to push through, have all of this amazing intake where they've pretty much gotten rid of all of their debt. They're vertically integrating their systems. They're getting more of their systems brought out. They're making more money, not just on sales, but also on service as well. That, and then they're also being able to show that the radiation therapy that they are producing is something that is an amazing thing to look at, because the health market is trying to still, I guess you could say, do a little bit more on the testing phase of things. But some have already ran through it enough where they're saying that this is a very competitive and a very sound way of treating the skin cancer. So now that they have had all of this exposure, then it shouldn't be too much and too far-fetched to say that they'll have more systems sold and more people using them. Therefore, this stock will start to actually generate more wealth in the stock with the shares, now that the company is debt-free and is continuing to just build on wealth. Along with the biggest stretch is their lobbying to try to get more systems brought into different areas of the health marketplace, along with boosting their sales across the world as well. so then it's not just in one area. So that is where I kind of see this stock moving to in the future. So the financials are actually looking really good for this stock, and the company's business model and their motto is definitely something to get behind, as they stand behind their product as well. So I hope you all enjoyed the video, and leave a like, comment, and please subscribe if you did like the video. And if there was something that I might have missed on this video, then drop it down in the comments below. And also, as always, if there is any stock that you are specifically interested in, or if there is a stock that you hold in your portfolio that I have yet to cover, then drop it down in the comments below too, because I'm always open to being able to do more research on different stocks and bring new stocks out to the community. So, this is the Stock Warden riding off. So y'all come back now, you hear?